Picture yourself waking up, reaching for your phone, and looking at your bank account like you normally do. Everything appears fine at first. Your balance is there. Your deposits came through. Nothing seems out of order. But behind the scenes, something has shifted. Curious, and most people have absolutely no clue it is happening. Because starting in 2026, a single number, $10,000, could silently determine whether your financial activity gets flagged, examined, or questioned. And here is the part that is catching so many people by surprise. Surprised, it is not just about large transactions anymore. It is about patterns, timing, and how your money flows. Even if every dollar is yours, even if you have done absolutely nothing wrong. For millions of retirees living on fixed incomes, managing savings carefully, helping family, or simply transferring money between accounts, ordinary behavior can suddenly appear suspicious to a system that does not know you, does not know your history, and does not care about intent. And once you are on that radar, what happens next can range from a simple letter to something far more disruptive. So the real question is what actually shifted and why are so many seniors at risk without even realizing it? Today on US Visa and Green Card Info, I am going to walk you through exactly what this $10,000 rule really means heading into 2026, what is actually changing behind the scenes, and why it is affecting seniors more than almost anyone else right now. We are going to break this down in a clear, practical way. No jargon, no scare tactics, just what you need to know to protect yourself and stay in control of your finances. I will also show you real-world scenarios that look completely normal on the surface, but can trigger attention under the current system. And most importantly, what simple steps you can take to avoid problems before they ever start. Because once you understand how this works, the entire situation becomes much more manageable. But there is one example in particular that makes all of this very real. And it starts with someone just like you. Let me introduce you to Patricia. She is 71 years old, a retired school teacher who spent over 3 decades in the classroom. She lives a quiet, structured life, and like many retirees, she manages her own finances carefully. Every month, her Social Security check is deposited into her account. Every so often, she transfers money from her savings to cover larger expenses, a medical bill, a home repair, a visit to see her grandchildren. Nothing unusual, nothing risky, just the kind of financial routine millions of seniors follow every single day. She has never tried to hide money, never missed taxes, never done anything even remotely questionable. But here's where things take a turn. Under the systems now being used and expanded heading into 2026, Patricia's perfectly normal behavior could start to look unusual, not to a person, but to an automated system trained to detect patterns. Because the system does not see a retired teacher managing her savings, it sees deposits, transfers, timing, and amounts. And if those patterns do not clearly match what is reported on paper, they can trigger attention. Not because something is wrong, but because something does not perfectly line up. And this is exactly where so many people get caught by surprise. Because to understand why Patricia and millions like her could end up on that radar, you have to understand where this entire system started. This goes all the way back to 1970 when the US passed a law called the Bank Secrecy Act. At the time, the goal was straightforward. Give the government a way to track serious financial offenses like money laundering, illicit trafficking, and tax evasion. As part of that law, banks were required to report certain types of transactions, specifically any cash deposit or withdrawal of $10,000 or more. That report is called a currency transaction report. And for decades, that $10,000 threshold has remained exactly the same. But here is what most people do not realize. That number was set over 50 years ago. Adjusted for inflation, $10,000 back then would be roughly equivalent to around $80,000 today. In other words, what was once considered a large, unusual transaction is now something far more common in everyday financial life. Retirement distributions, home-related expenses, even certain types of savings transfers can easily reach that level without raising any real-world concern. But the system never adjusted. The number stayed frozen in time. And now, as financial activity has grown and evolved, more and more ordinary people are brushing up against a threshold that was never designed for today's reality. Which raises an important question. If the rule itself has not changed, why does it suddenly feel like the risk is increasing? And the answer to that question starts with something most people have never even heard of. but it is one of the biggest reasons accounts get flagged today. It is called structuring. Now, on paper, structuring is pretty simple. It is when someone intentionally breaks up a large transaction into smaller amounts to avoid triggering that $10,000 reporting requirement. For example, instead of depositing $15,000 all at once, someone might deposit $9,000 today, another $9,000 tomorrow, and keep everything just under the threshold. That pattern, even though each individual deposit is under $10,000, is considered a warning sign. And in serious cases, it can actually be treated as a federal offense. And when you hear that, it probably sounds reasonable. The idea is to catch people who are deliberately trying to conceal money. But here is where things start to get complicated because the system does not actually know intent. It does not know why you made those deposits. It only sees the pattern. And that is exactly where seniors, more than almost any other group, start to run into trouble without realizing it. A lot of older Americans did not grow up in a world of digital banking and automated tracking. Many still prefer cash. Some keep money at home. Others make smaller, more frequent deposits simply because that is how they have always managed their finances. It feels safer, more controlled, more familiar. But to an automated monitoring system, that same behavior can look almost identical to someone trying to avoid reporting rules. And that is the disconnect. What feels normal to you can look suspicious to a system that is only trained to detect patterns, not understand people. There have been real situations where individuals, completely law-abiding, had their accounts flagged simply because their deposit habits did not fit what the system expected. No wrongful intent, no hidden income, just a mismatch between human behavior and machine interpretation. And once that flag is triggered, it can set off a chain reaction that most people are not prepared for, because this does not just stop at a report being filed somewhere in the background. In some cases, it escalates. Accounts can be examined more closely. Transactions can be questioned, and in more serious situations, especially when structuring is suspected, funds can actually be frozen while things are investigated. There have been documented cases where individuals had tens of thousands of dollars tied up for months, sometimes longer, simply because their transaction patterns raised concerns. And what makes this even more difficult is how the process works once that happens. In certain situations, the burden shifts to you to prove that your own money is legitimate, not the other way around. That means gathering records, explaining transactions, sometimes even hiring legal help just to regain access to funds that were yours to begin with. For someone living on a fixed income, that kind of disruption is not just inconvenient. It can be financially devastating. Now, to be clear, this is not what happens to most people. Millions of transactions are reported every single year, and the vast majority never lead to any follow-up at all. But the reason this matters, especially now, is because the system that decides which cases get attention is changing. And that is the piece that brings us directly into what is happening next, and why 2026 is such a turning point. And this is where things shift in a way that most people have not fully grasped yet. Because heading into 2026, the biggest change is not the $10,000 rule itself. It is how that rule is being utilized. For decades, these reports mostly sat in massive databases with limited ability to analyze them in a meaningful real-time way. There was simply too much data and not enough technology to connect all the dots. But that is no longer the case. The IRS now has significantly more funding, more advanced systems, and far more sophisticated tools designed to analyze financial data at scale. What used to require manual review can now be done automatically. Patterns can be detected instantly. Transactions can be cross-referenced against your reported income, your tax filings, and your financial history without any human ever looking at it first. So, what does that actually mean in plain terms? It means the system is no longer just collecting information. It is interpreting it. If money moves into your account, the system can ask, does this match what this person claims to earn? If there are repeated deposits, it can ask, does this pattern resemble known risk behaviors? If there are inconsistencies, even small ones, it can flag them for further review. And all of this can happen quietly in the background without you ever knowing it is happening. The rule did not change, but the enforcement did. And that one shift is what is making the $10,000 threshold more relevant, and in some cases more risky than it has ever been before. Now, this affects everyone to some degree. But seniors are in a uniquely vulnerable position within this system. And the reason comes down to how retirement finances actually work in real life versus how they look on paper. During your working years, income tends to be predictable. You receive a paycheck, taxes are withheld, everything is relatively straightforward. But in retirement, that structure changes completely. Income starts coming from multiple sources: Social Security, pensions, retirement accounts, savings, and it does not always follow a clean, consistent pattern. One month might be quiet. The next might include a larger withdrawal, a transfer, or a one-time deposit. To you, it makes perfect sense. But to an automated system looking for consistency, those variations can stand out. Take retirement distributions, for example. If you withdraw money from an IRA or a 401k, especially for required minimum distributions, those amounts can easily exceed $10,000 depending on the size of your savings. That transaction gets reported. And if your tax return does not clearly reflect or explain that movement of money in a way the system can quickly match, it can raise questions. Not because anything is wrong, but because the system is designed to flag what it does not immediately understand. The same thing applies to other common situations seniors face: moving money between accounts, consolidating funds, or covering large irregular expenses. These are normal financial decisions, but they do not always look normal through the lens of automated analysis. And that is really the core issue. It is not that seniors are doing anything wrong. It is that their financial lives are more complex, more variable, and more likely to produce patterns that do not neatly align with what the system expects. Which is exactly why certain everyday situations, things many retirees do without a second thought, are becoming some of the most common triggers for attention. And once you see what those situations are, you start to realize just how easy it is to accidentally fall into one of these patterns without even knowing it. So, let us walk through the situations that matter most, because these are the exact moments where completely normal financial behavior can start to look questionable from the outside, even when everything is perfectly legitimate. The first one is retirement distributions. This is one of the most common triggers, and almost no one thinks twice about it. You have spent decades building your savings, and now you are drawing from those accounts to live your life. Maybe it is a required minimum distribution. Maybe it is a larger withdrawal to cover a major expense like home repairs or medical bills. Either way, it is your money. But if that distribution crosses certain thresholds, especially around or above $10,000, it gets reported. And if the timing or amount does not clearly line up with what is reflected on your tax return, even temporarily, it can raise a flag. Not a judgment, just a question. But that question can be enough to put your account on the radar. The second situation is gifting money to family members. This is something many seniors take pride in. Helping children, supporting grandchildren, contributing to major life moments like education or purchasing a home. And in most cases, it is completely legal. But the way those gifts are given matters more than most people realize. Large transfers, repeated transfers, or cash-based gifts can all create patterns that look unusual if they are not clearly documented. The system does not see generosity. It sees movement of funds, and if those movements are not easy to interpret, they can trigger attention, especially when multiple transactions occur within a short period of time. The third is major life transitions like selling a home or receiving an inheritance. These are big financial moments, often involving large lump sums that move through your accounts all at once. Maybe you are downsizing, relocating, or handling a family estate. The numbers involved can be significant, sometimes far beyond that $10,000 threshold. And while these transactions are entirely legitimate, they can create temporary spikes in your financial activity that stand out sharply compared to your usual patterns. Again, it is not that anything is wrong. It is that the system is designed to notice when something changes suddenly. And the fourth situation is one that flies under the radar for a lot of people: cash-based habits or informal financial arrangements. This includes things like selling personal items, collecting rent, or even helping a family member by temporarily holding money and then transferring it later. These situations often involve cash or multiple smaller transactions. And when those transactions start to form patterns, especially patterns that resemble structuring, they can raise concerns. What feels like simple everyday money management can look very different when it is reduced to data points on a screen. Now, Here is where it becomes especially important to understand what happens next. Because once a transaction or pattern is flagged, it does not automatically mean there is a problem, but it does mean your information enters a system designed to take a closer look. When a bank files a report, whether it is tied to a large transaction or a suspicious pattern, that information is sent to a federal database managed by the Treasury Department. From there, it becomes accessible to agencies like the IRS, which use their own tools to analyze whether anything needs further attention. In many cases, nothing happens at all. The report sits there part of a much larger data set never acted upon. But if something stands out, if there is a mismatch, a pattern, or a question that cannot be easily resolved by the system, that is when it can move to the next step. And that step is usually contact. It might start with a letter asking for clarification about specific transactions. Straightforward, but still unsettling if you are not expecting it. In other cases, it can escalate into a formal review where your financial records are examined more closely over a period of time. And in more serious situations, particularly when patterns resemble structuring or unexplained cash flow, the consequences can become more immediate. Accounts can be restricted. Funds can be temporarily frozen. And in rare but very real cases, legal processes can begin that require you to actively prove where your money came from and why it moved the way it did. That is the part that catches people by surprise because at that point, it is no longer just about understanding the rules. It is about responding to them under pressure. Now, before this starts to sound overwhelming, there is something important you need to know. Because while all of this is real and the risks are increasing, there is another side to this that most people never hear, and it changes how you should think about everything we have just covered. Now, here is the part that almost never gets explained, but it completely changes how you should think about all of this. The vast majority of these reports never lead to anything. Millions upon millions of transactions are flagged, recorded, and stored every single year. And most of them are never reviewed by a human being. No letter, no review, no follow-up, nothing. And that is important because it means the system is not designed to go after every retiree who deposits or moves money in a slightly unusual way. It simply would not be possible. But, and this is the key shift, the system is getting better at narrowing its focus. It is no longer about volume. It is about precision. With more advanced tools, better data matching, and automated analysis, the IRS does not need to look at everything. It just needs to identify the patterns that stand out the most. And that is why the risk, while still relatively low on an individual level, is increasing in a very specific way. It is becoming more targeted, more selective, more dependent on whether your financial activity is easy to understand or confusing when viewed through data alone. So the real goal here is not to avoid the system entirely. That is not realistic. The goal is to make sure that if your financial activity is ever reviewed, it makes sense immediately. No guessing, no ambiguity, no unanswered questions. And this is where things shift from awareness to control, because there are a few simple practical steps that make an enormous difference. And the first one is also the most powerful. Keep clear, organized records of your financial activity. Not just your monthly statements, but anything tied to larger or less frequent transactions. If you sell your home, keep the closing documents. If you receive an inheritance, keep the paperwork that shows where that money came from. If you take a distribution from a retirement account, save the statements that explain it. And if you give money to a family member, write it down. Date, amount, and purpose. Because if a question ever comes up, the difference between a quick resolution and a prolonged issue often comes down to one thing: documentation. The system may flag a transaction, but it cannot argue with a clear paper trail. The second step is working with the right kind of professional. And this is especially important for seniors because retirement finances are not as simple as they used to be. A qualified tax professional, someone who understands retirement income distributions and reporting requirements, can help you organize things in a way that is both compliant and easy to explain. They can make sure your tax filings reflect what is actually happening in your accounts, so there are no disconnects. They can also guide you on things like gift reporting, large transfers, and timing. Small adjustments that can prevent confusion later on. This is not about doing anything differently in a major way. It is about making sure everything lines up clearly across the board. And the third step might sound counterintuitive at first, but it is critical. Avoid trying to stay under the radar by breaking up transactions. If you need to move a large amount of money, do it cleanly in one transaction and document it properly, because multiple smaller deposits that fall just under $10,000 can look far more suspicious than a single larger one that is clearly explained. This is one of the most common mistakes people make, not out of bad intent, but out of caution. They think they are being careful when in reality they are creating a pattern that draws more attention. Transparency, when it is backed by documentation, is always the safer path. Now, there are a few more steps that become just as important once you understand how this system actually works, especially when it comes to your rights, your family, and situations that most people never think twice about until they become a problem. The next layer of protection comes down to something a lot of people do not think about until it is too late, and that is understanding your rights and how to respond if you are ever contacted. Because if you do receive a letter or a notice, the worst thing you can do is panic or ignore it. These situations are almost always manageable when handled correctly. You have the right to understand why you are being contacted. You have the right to respond with documentation. And most importantly, you have the right to representation. That means you do not have to figure it out on your own. A qualified tax professional or attorney can step in, communicate on your behalf, and make sure everything is handled properly. In many cases, what looks serious at first is resolved with clear records and a simple explanation. But timing matters. Responding early, calmly, and correctly can prevent a small issue from becoming something much larger. Another step that becomes incredibly important, especially for seniors, is making sure that any financial help between family members is handled in a way that is easy to track and explain. This is where a lot of confusion can happen without anyone realizing it. Maybe an adult child is helping cover expenses by depositing money into your account. Maybe you are helping a grandchild and sending funds regularly. On a personal level, it is simple and generous. But from the system's perspective, repeated deposits, especially in cash or inconsistent amounts, can start to form patterns that do not immediately make sense. Thoughtful, and again, the system does not understand relationships. It understands data. So the best way to handle this is to create clarity. Use methods that leave a record like checks or electronic transfers and keep notes about what those transfers are for. It does not need to be complicated. It just needs to be clear. Size. And then there is something that often goes unspoken, but it plays a very real role in all of this. Life changes. As people get older, managing finances can become more complex. Not necessarily because the money is complicated, but because the systems around it are. Some seniors begin to rely on family members to help manage accounts, pay bills, or move money. Others set up automatic transfers or shared access without fully revisiting how everything is structured over time. And in situations where memory or cognitive clarity begins to decline, even slightly, it becomes easier for transactions to happen without a full understanding of how they might appear from the outside. That is not a failure. It is a reality many families face. But it does increase the importance of having the right protections in place. If you are helping a parent or relative manage their finances, make sure everything is set up properly. That means having legal authorization, like a power of attorney, so there is no question about who is managing the account and why. It also means keeping detailed records of anything you do on their behalf. Every transfer, every payment, every deposit should be easy to explain if needed. Not because you expect a problem, but because if a question ever arises, you are prepared to answer it immediately and clearly. That level of organization protects both the person managing the money and the person whose money it is. Because at the end of the day, most of the issues that come out of this system are not caused by wrongdoing. They are caused by confusion, gaps between what actually happened and what can be clearly shown. And when you close that gap, you dramatically reduce the chances of ever running into a problem in the first place. But there is one more area that deserves attention because it is not just about how the system sees you. It is also about how bad actors can take advantage of it, and how quickly a normal situation can turn into something much more serious if you are not aware of what to look for. One of the most overlooked risks in all of this has nothing to do with the IRS directly, but it can still pull you into the same kind of trouble, and that is financial fraud schemes. Because right now, there are criminals specifically targeting seniors with instructions that sound simple, urgent, and oddly specific. They might ask you to withdraw cash, move money in smaller amounts, or send funds in a way that avoids attention. They will often create a sense of pressure, telling you it is time-sensitive, confidential, or tied to something important like a family emergency, a legal issue, or even a supposed government request. And in the moment, it can feel convincing. But here is the hidden danger. Those exact instructions, moving money in smaller amounts, acting quickly, avoiding normal channels, can create patterns that look exactly like structuring or suspicious activity. So, not only can these fraud schemes take your money, they can also leave behind a financial trail that raises warning signs in the system. From the outside, it may look like you were intentionally trying to move money in a certain way when in reality, you are being manipulated. And that is what makes this so serious, because once those patterns exist, they do not come with context. They do not explain that you were under pressure or misled. They just show what happened. That is why one of the most important habits you can build is this. Anytime you are asked to move money in a way that feels unusual, rushed, or secretive, pause. Take a step back. Talk to someone you trust before doing anything. A family member, a financial advisor, even your bank. Because one conversation can prevent a situation that is not only financially damaging, but incredibly difficult to untangle afterward. And beyond all the rules, the reporting, and the systems, there is a deeper issue here that a lot of people feel but do not always say out loud. It is that sense of being watched, of having your financial life monitored after decades of doing everything the right way. For many seniors, that feeling is not just frustrating. It feels personal. You worked, you saved, you followed the guidelines, and now it can seem like normal behavior is being viewed with suspicion. And that tension is real. On one side, there is a need to prevent serious financial wrongdoing. On the other, there is a very human desire for privacy, independence, and control over your own money. That balance is not perfect, and it probably never will be. But understanding how the system works gives you something important. It gives you control within that system. Because once you know what triggers attention, once you understand how your financial activity is being interpreted, you are no longer guessing. You are making informed decisions. You are documenting what matters. You are avoiding patterns that can be misunderstood. And that shifts the entire experience from uncertainty to clarity, because this is not about changing your life or being afraid to use your own money. It is about making sure that the way you manage it is as clear on paper as it is in reality. And when you do that, most of the risk we have talked about simply fades into the background where it belongs. Now, looking ahead, there is one final piece you need to understand, because what is happening now is not a one-time change. It is part of a much larger shift that is still unfolding, and it is going to shape how financial systems work for years to come. As we look ahead, it is important to understand that what is happening right now is not temporary. It is part of a long-term shift in how financial systems operate. The move toward more data, more automation, and more real-time analysis is not slowing down. If anything, it is accelerating. Every year, the technology becomes more advanced. The systems become more connected, and the ability to detect patterns becomes more precise. And that is true regardless of politics, administrations, or policy debates. The tools are already here, and they are only getting better at doing what they were designed to do: analyze financial behavior at scale. Now, that does not mean the guidelines themselves will not evolve. There will continue to be debates about thresholds, privacy, enforcement, and fairness. Some proposals will move forward, others will be scaled back, just like we have seen in the past. But the overall direction is clear. Financial activity is becoming more transparent to the systems that monitor it. And that means the habits you build now, keeping records, staying organized, understanding how your money moves, are not just helpful in the short term. They are becoming essential parts of managing your finances in the modern world. But here's the part that matters most. None of this takes away your ability to manage your money confidently and safely. You are not powerless in this system. In fact, once you understand how it works, you are in a much stronger position than most people, because the risks we have talked about do not come from doing normal things. They come from doing normal things without clear documentation or awareness of how they appear. And that is a problem you can solve. You can keep records that tell the full story. You can work with professionals who make sure everything lines up correctly. You can avoid patterns that create confusion, and you can stay informed as these systems continue to evolve. Those are simple, practical steps, but they make a massive difference. They turn something that feels uncertain into something that is completely manageable. At the end of the day, you have spent your life building what you have. You have earned the right to use it, enjoy it, and share it without unnecessary stress or fear. And the goal here is not to make you worry. It is to make sure you are prepared. Because when you understand the guidelines, when you know what to watch for, and when you have a clear plan in place, you can move forward with confidence, knowing exactly where you stand. If this helped clarify things for you, consider sharing it with someone who might need to hear it. Because a lot of people are still unaware of how these changes can affect them. And if you have questions or specific situations you would like covered, let me know right here on US Visa and Green Card info. There is a lot more to explore when it comes to retirement finances and protecting your financial future.